You're listening to the Rite Retirement Show.
The 70% of people out there listening to the show today are going to need some level of care. It doesn't necessarily mean that 70% are going to end up in a nursing home, but 70% of people will need some assistance out there. The biggest fear is running out of money for the retiree, but what we see is not enough people spend enough of their money.
Cris prides himself in what matters to you. This is the Rite Retirement Show.
Hi there, I'm Luann Fulmer, and I want to welcome you to the Rite Retirement Show with my friend and certified financial planner, financial advisor as well, Cris Wallace. He's president at WG Financial Group. And then joining us, as always, Graham Bauer. He's also a certified financial planner, financial advisor, and an enrolled agent there at the firm. And now, if you have questions, here's the way to reach out for a complimentary discovery session, 256-937-2010. Here's the deal. You can call that number, or you can text the word visit, 256-937-2010. Either way, you can get on their calendar and it's complimentary. Also, remember, check us out on Facebook throughout the week. Anything that happens in the news, Cris is sure to post something on WG Financial Group 256. You can always keep up with the latest headlines there. Plan, retire, and play. That is our motto, and so excited to get talking about that. Look for us at wgfinancialgroup.com. And then remember, our show is available wherever you get your podcasts. Okay, Spotify, Apple. Search for the Rite Retirement Show. Cris and Graham, so excited to get going today.
Luann, it's great to be here with you, as always.
Thank you.
Hey, Luann, how are you today?
Doing great, guys. So as always, we start off with real talk. But this week, it's something that that happened to Cris. He really ran into someone. And so this is going to be kind of a little bit different, but tell us about it, Cris.
Yeah, this really happened, as we said pre-show. So, I was meeting with somebody this week, and they had been to a class locally, and they were asking me, really the individual was telling me that they'd been to a workshop, and the individual was a certified financial fiduciary, and that was like a super highly regarded designation. And I'm not going to disagree with the term itself being highly regarded, because I truly didn't know what the requirements were for this designation. So the first thing I look at is continuing education. 10 hours annually is all that it requires. And then really, probably the most important part is it's an online closed book exam. So you do have to be careful when it comes to designations. And I think for me personally, if I'm a consumer looking for someone that is a fiduciary, I think you have to look a little bit deeper than just a designation. I think a lot of times your actions will also speak for that. As a certified financial planner professional, I would encourage listeners to go to the CFP website and read up on the designation, read about training that we have to go through, the testing that you have to go through, and what the board requires of those that represent those marks. And I think there's a lot of designations in general out there today. There's you've heard it called alphabet soup in some cases. So do your research on those and make sure that, the person that you're considering to assist you with your financial efforts is really acting in your interest. So that's kind of my words. I don't want to say a whole lot about that. It's just do your research, right? I mean, we've been on the air since 2016. There's been people that listen to us. I'm sure they've went to our website. I'm sure they researched Cris Wallace, Graham Bauer. Fine, do that. That's all I'm saying is continue to do that. Don't take somebody's word for it, and do your research there.
Yeah, I'll add one thing because I agree with that. I do think, and of course we're always going to be a little bit biased, but
100%.
If you do some research, you get opinions of other consumers, other people in the industry. So I do think it matters a lot, just so you know too, that you're dealing with somebody who's going to have a view at what you're doing, because you can have this designation or that in this area, but for most people, they're really looking for a more a more wide view of everything rather than like, oh, I just want to make sure you're really, really good at this one specific thing. That's what, people go to CPAs for and go to attorneys for is I want you to do this one thing for me.
Yeah. And while you were talking, Graham, not that I was ignoring you, but I was for a second. So I was actually just typing something okay. Because I think when people hear the word financial advisor, I think they automatically just think about investments. And when Graham and I on the show, and we're talking about retirement planning, we're talking about planning as a whole. So there's a lot of things there. So chartered financial analyst, which honestly, probably the hardest test that anybody could take.
Yeah.
I believe it's a 3-part test. It's brutal. It's
insanely low pass rate on that one.
Yes, yeah. Insanely low. Actually, would argue that is the hardest test out there.
But again, if you look at something like this, not to put it down at all, it's just because it's usually people who are CFAs are not planners necessarily. They're analysts.
Okay. Managing portfolios.
Yeah, they're,
right.
It's like a lot of, CFAs might still be helping on the back end, but they're not necessarily the person you're going to sit down with and, plan a social security strategy or something like that. Not that there is nobody that has that designation that does that. It's just, less, like I was saying before, of the holistic approach, more of the really zeroed in, hyper focused on that one area and, better than anybody at that.
Another insanely hard test to pass the CPA exam. And then lastly is the chartered financial consultant. So you can do research pretty easily to vet designations to figure out where the focus is. I'll just take it a little bit step further here and just say the reason I went after the CFP was they cover so many elements of financial planning. And it was, by many, and again, you can do your own research here. It's considered to be the gold standard in the planning industry. So my wife and I in 2015, when we started this process, or I started the process, or rather she started me on the process is the story. It was to differentiate myself from other financial planners in the industry and to increase my knowledge and to know that when someone came in to sit down with me or a family came in to sit down with me, that I've seen lots of things and I've passed the exam and I've had exposure. Being a CFP doesn't mean you're the smartest guy in the world. It really doesn't. It doesn't mean you're the smartest girl in the world if you're a CFP. We have female CFPs on staff at our office. But what it does mean is that you've probably been exposed to a lot of different things. And our focus, as people know that listen to the show, is really towards retirement planning area. But there could be some other things that were covered in the CFP that we don't see very often, but we've had exposure and we can go in and reference a book or a note or something along those lines. So again, as you're seeking out a financial planner, and whether it's us or somebody else, just make sure you're vetting the designations behind the name for sure.
I love it. Very good. So that was interesting that you ran into that person,
Well, I ran into someone who ran into.
Okay.
Yes.
Friend of a friend.
A friend of a friend,
okay.
right.
I got it. Very, very good. Okay. So let's talk about, the Federal Minute. Give us what we need to know this week, Chris.
Yeah. So the Fed Minute this week actually has to do more with Social Security. So it was from an article from Fed Week. Was produced on August 21st. And essentially, Social Security ain't getting any better. That's the bottom line. It's just, it's expected, the trust funds are expected to run dry until in 2034. And if action, the longer they wait, the more likely drastic things have to be done. And I can't believe that we're not addressing that now. And the reason why, it's just really unpopular. So one of the larger fixes that was mentioned in the article was increasing the payroll tax. And Graham, you and I have talked about this on a number of occasions. And immediately, so in 2024, they were projecting a 3.3% payroll tax increase. And now we're in 2025, now they're saying a 3.65. So if we don't do anything and we wait all the way to 2034, now they're looking at a 4.27% payroll tax increase. So we do need to act sooner than later. Obviously benefit cuts are there on the table, but I'm of the mindset that they're not going to cut benefits. I believe wholeheartedly that they're going to do some other things like raise the wage-based cap, and they're going to increase payroll tax. As Graham and I have noted on a number of occasions, it hasn't been changed since 1990. So it wouldn't surprise me to see that go up. Doing some things to cost of living. switch to a different inflation measure on cost of living. We've mentioned that on the show before. And so I think, even doing means testing to some of the benefits, but I don't think we're going to see a 75% reduction. But I do think if you're probably younger than 50 years old out there today listening to the show, Social Security will look a little different, 15 years down the road than it does today. So those are kind of some things that the article mentioned. Again, it's not necessarily related to Feds, but it was on Fed Week, which is a big Fed article publication.
Yeah, and it's part of, federal, technically it's a federal benefit, not federal employees necessarily. But, I think we talked about this plenty of times, but I think there's some interesting just statistics to look at on, not just the amount of people on Social Security, but like we've talked about before, the amount of people kept above the poverty line due to Social Security, which is estimated to be around 22 million people in the United States. So, forget even like taking benefits away completely, reducing benefits could even be, something that could kick a ton of people under the poverty line. There's even about 1 million children in the United States that are kept above the poverty line due to Social Security benefits likely that they're receiving from a deceased parent, or maybe they have a parent that's old enough to be collecting benefits. There are different scenarios where children can be getting Social Security benefits as well. So, but obviously the biggest group it affects is those 65 and older. So currently, the percentage of seniors 65 plus in poverty is about 10%. If you cut out Social Security, it would be pushing 40%, be in the high 30s. So that's the largest voting bloc in the United States, one of the most vulnerable groups in the United States. So again, like we've said, we're definitely of the mindset that, no one is in federal government wants that to happen. It's just going to be a question of, how they do that. And I do think payroll taxes are going to be the most unpopular because they really are kind of the worst kind of taxes to increase because there's really no way out of them. I mean, if you got an increase in a payroll tax, you can't deduct your way out of excess payroll taxes. You can't 401k contribute your way out of payroll taxes. There's like a few slim exceptions for money that doesn't get taxed for Social Security and Medicare. So, that's going to, you're probably going to feel a 3.4% payroll tax increase more than you would feel a 3% federal tax increase, just based on all the different marginal rates and everything. So I do think that would hit people a little harder than they think. So I hope that we address it sooner than later, but I'm not optimistic that it will be addressed quickly and, done well, but I am optimistic that it will be addressed at some point.
I hope so.
For sure. How many people did you say was on Social Security right now?
That are lifted above poverty by Social Security?
Okay. I missed. Okay, yeah. So just in general.
I think it's about 25% of the United States population is on some form of Social Security.
21, but you're close.
Okay, I was a little over.
Okay.
Yeah, no, you're close. That's a lot of people.
It's a ton of people.
That's why we don't think that they'll cut benefits because there's just too many people on it. You got retirees, as you mentioned, the biggest voting bloc. You've got survivors, you've got disabilities, kids that are on it as well that have lost parents and have disabilities themselves. So, it's actually, according to the SSA.gov back in June, it's 21.3%. So a lot of people.
Yeah. A lot of people.
A lot of people.
So they are just kicking the can down the road until they absolutely have to do something about it. But
that's what they do best, right?
Yeah, that is exactly what they do best. So, okay, thanks for that Fed Minute. Now let's go to the market. Tell us what's happening with the market.
Yeah, so I think right now I just kind of want to focus back on Powell's talk last week where he just kind of reaffirmed the 2% target, but the game has changed a little bit. They're looking more, I think kind of the words he used is kind of like an average of 2% versus trying to drive it back down to 2% right now before they cut rates because the languaging that he used does kind of look much more favorable for a rate cut in September. So some people would say, well, shoot, we just had a CPI print of 2.7. Are they giving up? And now it's like, well, maybe we just shoot for the average over a longer period of time. And so the markets today, actually today that we're recording are actually up. It's been a little bit of a struggle. I think the market is kind of looking for some really concrete evidence of what's really going to happen. We've seen a little bit of an upward trend in unemployment. And at the same time, we've seen, Graham, if you're looking at like the CPI data that we've looked at, it has just kind of flatlined around that 2.7-ish range. And it's slightly trending down, but it's for the most part kind of flattened off at that 2.7. So I don't know how much they can cut rates. And I said this on my quarterly client call. It's the funny thing to me is, all right, so remember when COVID was around, and COVID was really bad for a lot of people, and it took a lot of people out of here for sure. And when I had it, I was fairly sick for a few days. But here's my point. Everybody became a COVID expert during COVID. And you're laughing, Graham. Am I right?
Yeah. It was like just all you ever saw was people.
Yeah.
I remember specifically like a popular, sports talk show that I listened to.
Yeah.
Putting out a podcast with like some person in the the CDC or something, and it's just like, what is happening? Why am I listening to an ESPN commentator talk about COVID with some public health expert? But it was a crazy time.
Yeah, it was. So guess what we have today? We have tariff experts.
Yeah.
And we have interest rate experts. And so I'm going to paraphrase like some of the things I'm hearing. It's like, oh yeah, I believe in the tariffs. It's doing the right thing for the U.S. And I don't know why we weren't doing it before. And I'm not going to disagree with any of that because, I think there are some goods that we need tariffs on.
Yeah, we've been pretty easy.
Yeah, I don't disagree with that. Yeah. I just think it's funny that now everybody's a tariff expert. So don't take this as being like hardcore political either way. It's funny because everybody now is a tariff. Well, now that there's been the struggle with Trump and Powell on dropping rates, if you're a supporter of Trump, you're like, I don't know why Jerome Powell's not dropping the rates. I don't get it. He's just being ugly to Trump. And there's some other words in there I can't repeat. But so now everybody's an interest rate expert. And I'll tell you, it is a risk. I'm going to be honest with you, dropping interest rates with, increasing tariffs right now around the globe. Again, I do agree with that. It's bringing in money for the country, so I'm not denying any of that. But in some cases, it is driving up the cost of goods today. But typically, a tariff is hopefully just a one-time increase. So inflation, like that number that just came out, the 2.7, that's year over year. So basically, year over year, the cost of a basket of goods increased by 2.7%. Well, when you throw a tariff on something or another country, well, that's usually just a one-time thing. It doesn't mean that it's going to increase by 30% every year. It's just 30%. So that part of it will stay a little bit stagnant. So again, I do agree with those, with the tariffs for the most part. But then the interest rate, again, the experts that are out there now, they're not really experts, are now saying, I don't know why he's not dropping interest rate. Well, I'll tell you why. Because inflation just kind of becomes stagnant around that 2.7%. And one of the risks in lowering interest rates is that it ignites the housing market again, or it creates a looser monetary policy. So money's going to be easier to move and flow within the economy, and it could reignite inflation a little bit. So it is a risk. Now, on the flip side of that, I do believe that is kind of the missing component to the administration right now and what they're doing with the new tax code. We've got tariffs coming in. And now I believe that interest rates, if lower, would really kind of ignite the economy. But there's risk in doing that. And I just think it's kind of funny that everybody now is a tariff and interest rate expert. And by no means do I claim to be a tariff expert, nor an interest rate expert. I just think it's funny that everybody now is either one of those or maybe both in some cases.
Yeah, I would love to go back to a year ago and just go on the street and ask people to explain to me what a tariff is.
Yeah.
And see how many people could have done it 18 months ago.
Yeah. So here's the other thing too, and then we'll move on to our stuff. We got some good tax stuff coming up today. We got some tax questions prepared. One of the most common questions that I get, or things that people don't understand, is the bond markets. I just don't understand bonds. I just don't understand the bond markets in general. Well, guess what? That has a lot to do with interest rates, but yet now we have a lot of interest rate experts out there. So I just find it really humorous. So we'll move on. I'll quit poking fun lightly.
Yeah.
So Anyway.
Well, I'm glad you brought that up, but I still don't understand how all the interest rates would actually stimulate, or whatever you call it, inflation, would cause inflation. If low interest rates causes people to be able to go buy things, I don't understand why it would cause inflation.
Well, it's supply and demand.
Supply and demand, I guess. Okay.
So if you drop interest rates, let's just take a house for an example.
Yeah, okay.
Like there's a lot of people that aren't willing to finance at a 7.5% interest rate.
Yeah.
But you drop that interest rate down and to where rates are dropping down into the fives. Now you've got a lot of those people that were sitting on the fence waiting to buy or refinance. And now they're going to be much more inclined to do that because a 2% drop in rates is a significant amount in a house payment.
Right.
So it just frees up more money. Well, when there's more money flowing around, so just think back to COVID again.
Mm-hmm.
Everybody had a lot of, the young people call it STEMI checks.
Right.
So stimulus, right?
Stimulus,
So we get
yeah.
the stimulus. And nobody had any supply at that point, and everybody had a lot of money. And it's the same thing. So now the seller side, the supplier side knows that the money's out there and available, and now they can charge more. The same thing happens with college. The same thing happens with college degrees.
Yeah.
They make money and loans so easily available via government loans nowadays. The collegiate institutions know this. And they're like, we can charge more.
I don't want that.
Well, listen, like if you don't hear anything I say today on today's show, just know that anytime there's government intervention or government spending, it's going to lead to some sort of inflation.
Mm-hmm.
Colleges, and I will not go down this path today because I will get angry about it.
I know.
It is the government's fault, I believe, that colleges now charge what they charge because they've made money so easy to get in the form of loans. And just look at the massive amount of student debt that we have out there.
Right, exactly.
So if young people listening to the show, if you don't hear anything that I say today, write this down. And this is gospel. This ain't gospel according to Chris. This is just straight up economic gospel. Government spending is inflationary. It ain't free.
Right. Nothing is free.
And I think it's funny because you would think that we would have all learned that lesson the last few years, maybe more than any time in the last 50. But it is still important to remember. But yeah, it'll be interesting to see like you said, and then we'll get off this soapbox. But the numbers that come out, next month, mainly because it is the only thing I also find a little funny about, everybody's interest rate expertise is I think to admit that we need an interest rate cut is to admit that this is maybe not the greatest the economy has ever been in the history of the world because you could
argue that.
I think, and I'm not saying it's a bad economy right now. I'm just saying that, both can't really be true because we need to be stimulating something if we're cutting. So I think what the Fed is telling us by that is, like you mentioned, we're prioritizing the jobs number more than we're prioritizing the inflation number. And, there is a little bit of risk, but there's also some reward. So it'll be interesting to see how that pans out with the numbers that come out the next few months.
Awesome. Okay. All right. Let's go ahead and get started with what you mentioned, Chris, our tax talk today. I know it's one of your favorite subjects. You are not a CPA, but, you are a certified financial planner professional. And so you have a very good understanding on how taxes impact someone in their pre-retirement working years, as well as when they're pulling income out in retirement. And you want to help them do it. You guys help them do it in the most tax efficient way. So excited to dive into some of your strategies that you guys use.
Yeah, I'm happy to do that. I think taxes, as we've said on the show a number of times, is probably one of the more confusing areas of retirement planning. And I think it's an area where if you really put together your income and your tax puzzle really nicely, you can really just make things a lot more efficient. And so, yeah, I'm looking forward to getting into some of the questions we have prepared today.
Okay, very good. So I guess I'll get started here. Taxes are confusing to most of us, and so that's why we're going to do this to kind of help educate people, bring some clarity. So I guess I'll go to my first question. So here we go. I'm going to start with the marginal tax rates, okay? They're now permanent, okay? Talk about those marginal tax rates and how we should actually view them.
Yeah, so the marginal rates are the ones that I think everybody knows about, looks at, and assumes that they're going to pay like in retirement. Like, for example, you see the rates are basically the brackets are the 10, the 12, the 22, 24, 32, 35, and 37. So a lot of times for retirees, they just assume that they're going to pay 22% in federal tax in retirement. And that's usually false for the large number of retirees that are retiring today. What the marginal tax rates are is it is the last dollar that's pulled. That's going to be the tax rate that you're going to pay. So, for example, for a single filer, the top of the 22 bracket is $100,525. So when you pull one extra dollar and now you have $100,526, that one extra dollar is taxed at 24%. So that's what the marginal tax rates are. So basically it's the rate in which the last dollar is pulled. And I think a lot of, I see this a lot with engineers when they're running their spreadsheet, they're looking at the last marginal rate that they're going to be in, thinking that they're going to pay a 22% rate. And that's just not the case, because you pay a little bit at the 10, you pay a little bit at the 12, and you pay, some at the 22, and so on and so forth as you continue to go up those marginal rates.
Interesting. Yeah, I didn't ever really understand those. So I'm glad you explained that. That's very, very good.
Yeah, I think it's confusing.
It is.
And it is confusing because when you you have to look at it like you're not paying, like even when you get paid in your paycheck and then you run it through your tax return, you're literally not paying 22% on all of that money. Mm-hmm. And I think as we go forward into the show or through the show, we'll kind of try to bring a little bit of clarity to that. I know we're almost out of time here in the first segment, but it is very confusing. And again, I've seen it time and time again where an engineer will come in with a spreadsheet and they'll have like the 22% rate of tax, or they'll have 24. And I'm thinking that's way too high. And then the rebuttal back is, well, I'm just being conservative. And I'm like, you're being real conservative. Like you're probably 10 to 12% too high on an average basis there. So it is important to understand how the numbers are run through the bracket so you can do some accurate projections there. And again, Luann, I know we're really out of time for this first segment.
Yeah,
so
sorry.
It'll be really good when we get into the other questions here, because we're going to get more into taxes and kind of sneaky taxes that are in retirement as well. So if you're catching the show on the way to church, you can always hop out to Apple Podcast or Spotify and catch the rest of the episode, listen to the whole thing in its entirety. Tell your friends about us as well. You can give us a call if you'd like to set up a discovery session to sit down and go over your situation and find out where you're going to be in the brackets and how taxes are going to play out in your retirement by calling 256-937-2010. Again, the number is 256-937-2010.
Market fluctuations can be unsettling, but a resilient plan can help maintain stability. Discuss how you might fortify your retirement strategy with Cris Wallace. Text VISIT to 256-937-2010 today to begin. Remember, text VISIT to 256-937-2010.
Are you a federal employee feeling pressure from the early retirement offers like VERA, VSIP, or the Deferred Resignation Program? Recent government initiatives have introduced significant changes to federal retirement programs, making employees feel pressured to consider early retirement or face potential layoffs. At WG Financial Group, we help guide federal employees through these uncertain times. Our team understands the complex federal retirement systems and can help you make informed decisions. Call 256-937-2010 to schedule your complimentary discovery session with us today. We'll help you assess your options and create a personalized retirement plan to help you feel more confident. Visit WGFinancialGroup.com or call 256-937-2010 to book your session. Firm is not affiliated with the U.S. government. Investment advisory services offered through AE Wealth Management, LLC, an SEC registered investment advisor.
If lingering doubts like, have I saved enough? Or will my retirement funds endure? Are on your mind, it's time to consult with Cris Wallace. Text VISIT to 256-937-2010. That's 256-937-2010 to book your appointment and get the answers you need.
And thank you so much for spending part of your day with us today. I'm Lou Ann Fulmer, and you're listening to the Rite Retirement Show. We're talking about taxes in retirement, and Cris says, they place a heavy emphasis on tax efficiency there at WG Financial Group because, we always hear, or the fact is, you've said, Cris, that taxes will likely be one of the largest expenses many people will face in retirement. So, okay, let's get on to another question here. And this is that you have mentioned income taxes are taxed differently, okay, at each marginal rate based on your income. And then at the end of the day, we pay a tax based upon those different rates, right?
Yeah, I can take this
good.
one.
Okay,
so,
go ahead, Graham.
Yes, so like Cris said in the last question, that's marginal rates. So, you have the 10, the 12, the 22, 24. And that's what's on your last dollar. So people are always scared of those marginal rates. And, if you throw out, the term, if someone's in a different tax bracket than me, it's just, kind of assumed, they make more money, they pay more taxes than me, which is true. But if you want to get to the number of what am I actually paying on average in taxes, that's what would be called the effective tax rate. So when you're running through, the 10, the 12, and the 22, let's just say you make $100,000 a year and you're married. At that point, you are going to be a little bit in the 10, the 12, and the 22. And your effective rate would be the average of what you're paying in all three of those different brackets. So, off the top of my head, without knowing any deductions or somewhere, I could say someone would probably be in the range of 8 to 12% effective rate if they were making $100,000 a year. So that means on your W-2 withholdings, you're not going to start the year getting taxed at 10%. And then once you've made a little bit more money, have less coming in from your paycheck. And once you've made a little more, have less coming in. Usually they'll just do it as an average to try to kind of target that effective rate throughout the entire year to get you where you need to be when you file. So, you're not owing too much or getting a huge refund back. So that is kind of that second component. And for so many people, I think they don't realize how low their relative effective tax rate will be in comparison to their income. I've talked to people who, in retirement have maybe some VA disability, they have Social Security coming in, a pension, and take some withdrawals and are in the high six figures in income and have an effective rate under 15% federal taxes. And they're talking about, I'm nervous to pull out a little bit more money. I don't want to pay more in taxes. And it's like right now, you're maybe paying a 12, 13% effective rate of federal taxes, no state taxes on, your pension, your Social Security, all that. So for a lot of people, I really think it is a bit more tame than they expect it to be. Now, if you're making a ton of money, that it might be a bit of a different story. But for your average person, I think it's a good thing to look at just to give you a perspective of how much am I really losing of my total income to taxes versus, what is just my top marginal rate being a more simple way to look at it.
Yeah, just to kind of back up some numbers here, Graham, just to give listeners an idea. So let's just say you have $130,000 of income and you're doing just the regular standard deduction. You're looking at an effective rate somewhere around 9%. So that's a far cry from the 22 because really 130 is in the 22.
As a married couple, I'm guessing?
As a married couple, yeah. So you've got, $130,000 and that married couple at that point would be in the 22. So part of that 130 is going to be taxed at 22. And to your point about the effective or average tax rate, part of it's at 22, some of it's at 12, some of it's at 10. And when you average all of that together and utilize the standard, it comes out to around 9% tax overall. Now, I like that because for me, that's an easy way for me as just a citizen here, just to look at my income and multiply it times 0.09, and I can come up with like roughly how much federal tax I would have to pay there. So I like that. Where I think you need to know your marginal rates are for things like Roth conversions. So if you've got $130,000 of income, and we know that the top of the 22 is at, I believe it's at 206. So we've got room inside that 22 for a Roth conversion. Well, if I do that Roth conversion inside of that 22 bracket, all of that is going to be taxed at the 22% level. So I think you do have to know both and understand and have a decent understanding of both as well.
Yeah, and that's what makes it trickier when you're in retirement versus working, like we've talked about before, because, typically, when you're processing a conversion or something for someone, you have to know, well, what are you withholding on your Social Security?
Right.
What are you withholding on your pension? You got to know the marginal rate. Effective rate's good to know because you don't want to really majorly over withhold on the conversion. You're getting less money into the Roth, but you also don't want to, under withhold there and get hit with that tax bill if you don't have the cash available to pay it. So I think it makes it way trickier than when you're just filling out a simple W-4 and then you have your employer kind of withholding based off your effective rate. You file, everything's all right, versus when it's, your responsibility. I talked to somebody the other day that we were processing some conversions and kind of looking at projecting forward maybe what they'd owe in taxes at the end of the year. And in doing that, we uncovered that they hadn't been withholding anything on their pretty large pension. And so looking at that, we were saying, okay, well, we have to take that into consideration of, there's going to be a big, probably even more taxes owed by the end of the year. Do you have the cash available for that? We can withhold for this conversion, but then there's going to be additional. So it just puts a lot more individual responsibility on the individual.
Okay.
Yep, absolutely. Great.
Awesome. Okay. So, Chris, you and I were talking pre-show about taxes, and you stated that there are several other levels within the tax code that trigger additional taxes. So I was wondering if we could maybe unpack those one by one.
Yeah, so just a few here that I'd like to talk about. So number one, and Graham, feel free to jump in on any of these, but you also, one of the levels you have is called the Medicare tax. And most of us that are working, and I say most of us because maybe there's some people skirting the system somehow, but when you're working, you pay into Medicare and Social Security via the FICA tax. And Medicare is 1.45 that you pay, and your employer pays 1.45. And once you go over a certain level of income, so for a married couple, it's actually $250,000. So if you're looking at an adjusted gross income of more than $250,000, you pay an additional 0.9 in what they call the Medicare tax there. And that is kind of hidden, but it goes back to what we were talking about earlier, Graham, when we talked about Social Security, payroll tax having to go up a little bit. Well, this 0.9 is kind of buried in there. And if you're a W-2 employee and you're making more than $200,000, then your employer automatically withholds another 0.9, regardless of your filing status at the end of the day. Because if a married couple is filing, and let's just say they have an income of, say, $235,000, they're underneath the 0.9 for a married couple at that point. But let's just say all of that income is the husband's, then during the year, the employer is going to go ahead and withhold 0.9 extra because they have to when somebody makes more than $200,000. So you'll end up getting that back. But you just need to know that if you're a higher income earner and you fall underneath the 250, you're being held, that 0.9 is being withheld from your check. So that's to me, that's kind of a hidden tax. It does happen. It does go up depending on your income. And let's make another example. Let's just say that each person, husband and wife, I'm trying to think through this as I talk through it. Husband makes $175, wife makes $175. So we're going to be at that. We're going to be over that 250 number we just talked about, right? So, but they're under, from a salary perspective, under the 200 threshold where the employer automatically withholds. So when they file their taxes, they're going to be above the 250. And now all of a sudden the employer did not withhold from either one of them because they were less than $200,000 in income. So now they're going to have to make that up on the return because as a married couple, they're going to be above that. Mm-hmm. So this is just one of the different levels that kind of a sneaky tax kind of slides in there. And we just want people to just be mindful of that. The other thing that happens north of $250,000 of modified adjusted gross income is the net investment income tax. Graham, are you okay to kind of take that one?
Yeah, the NIT tax. So that's I would say this one probably hurts a little bit more the additional Medicare tax, it's in there. And if you're making, $400,000, $500,000, $600,000 a year between you and your spouse, and you're, not accounting for that, yeah, that could hit you a little bit harder on your taxes. So the net investment income tax, there's a couple calculations of how they calculate it, but the primary one that usually applies to people is it applies to their investment income over, if they have adjusted gross income over $250,000. So what that means in, general terms is if you're making $300,000 a year and you have, let's just say $20,000 of bank interest, well, you're going to get taxed at, I guess, we'll just use basic numbers, say 32% marginal. And on top of that, you might have some state taxes. If you're in Alabama, now you're up to 37%. And on top of that, you're going to have this additional 3.8% net investment income tax. So on that $20,000 of interest, you could be pushing 40% in total federal taxes on that interest. So the 3.8 is not going to apply to all of your income over the threshold, but it is going to apply generally to your investment income over the threshold for most people. So that's another one that, you don't really hear a lot about, but I think more people are paying it than they realize. One thing that's really common, and, I was talking to someone pretty recently who owed, in the, I guess 10, 20,000 on their taxes last year. And they were like, I don't know how this happened. My withholdings seemed pretty correct from work. I'm just a W-2 employee. I didn't sell a bunch of stock or anything. And, you look at their money market account and they got $300,000 sitting in cash. And that $300,000, is pulling in, 4 or 5%. And that's getting taxed at 40% based on their income. And it's like, okay, well, there's $6,000 or $7,000 in federal taxes owed that you didn't know about. So if you owed $10,000 last year, 7,000 of that was probably because you didn't account for this extra interest. So how can we mitigate that in future years? Find some equivalents, tax equivalent yields and all of that good stuff. But it is one of those other sneaky ones that, you pay federal taxes on this interest, but if you're a high income earner, you're building up this cash, it could really push your, your investment income, your interest, your dividends, your capital gains into, much higher. I shouldn't say much higher, but, a 3.8%, almost 4% isn't nothing. That's almost equivalent to, another Alabama state tax. So it's just something to be mindful of.
Right. And I want to go back and correct something that I think I said, because sometimes I listen to these shows back and I'm like, I said that incorrectly. So the difference between the 0.9 Medicare tax and the NIT tax is based on modified adjusted gross income. Your 0.9 Medicare tax is not. It's based on your earned income. So I just want to make sure that's clear. I think I may have said that it was based upon modified adjusted gross income. And so I want to go ahead and correct myself before I'm slapping myself on Saturday listening to the show.
Yeah.
But so point being is the more money you make, there's these different levels. I call it kind of a spider web of taxes that the IRS has. Another one that I think we can talk about here is for the retiree, and maybe it's not even for the retiree in some cases, is the IRMA limits, the income-related monthly adjustment amount. There are different levels to that. And, as you cross those thresholds in retirement, there's 5 different levels that you can cross over into. And your Medicare premium for a married couple can just grow like substantially over and above what you would be paying if you stayed under the first IRMA limit. So the highest right now for like a married couple is $628.90 per month per person.
That's Part B too. Is that not including Part D, or is it?
It's not including Part D. That's just B. On top of that, you've got D to worry about there as well. So it can grow substantially. Now, where this comes into play is at 63. So if you're 65, and let's just say you're retiring at 65 and you sign up for Medicare and they send you a letter saying your Part B premium is going to be, $185 a month. And then what's going to happen is you're going to get a secondary letter and they're going to send it to you and they're going to say, we were just kidding. It'll be worded more professionally. It's like, we're just kidding. It's not 185. That year, you had a modified adjusted gross income north of $266,000. So now your Medicare premium is actually going to be $370 per month.
Oh, yikes.
Yeah. So they start looking at that. The point of telling you this is they start looking at that at age 63. So you have to, as a taxpayer and a retiree, somebody considering Roth conversions or working or whatnot, you have to think about that at 63. Like, what's my income going to be at 63? Now, there is a way to get around this. So I guess the person that's hurt most is probably the retired military on TRICARE, Graham, if we kind of talk about them for a second.
Yeah.
Because at 65, in order to continue the TRICARE for life, they do require you to go ahead and sign up for A and B at that point. So at that point, you're on A and B, and let's just say you're getting a military pension and you're still working and you're making $200,000 a year, for example, in a salary. Now, all of a sudden, you've got the pension, the salary, and you're through the first one or two IRMA limits. And then your Medicare premium is going to be increased until you retire. And at retirement, you can then turn around and you can file SSA-44, and then you can go back to Medicare with a letter, the letter being SSA-44, and say, just kidding, you can't charge me more now because I'm no longer working, because one of the life-changing events at the top of SSA 44 is work stoppage. So, once you stop, you can actually get it reduced, but you're going to have to be able to prove that, obviously, that you retired at that point. You can also do that at 65 if you are retired, and Medicare sends you that letter saying, hey, you've got to pay an extra premium on IRMA because you went through the IRMA limits because you made so much at 63, and then you can still do the same thing as just a regular, citizen. File SSA 44 and say, oh, well, hey, at 63, I was actually still working and I was making a big salary. I'm no longer working, and I haven't been working since age 64, and then you can get it reduced that way as well. So look into those options, especially towards the tail end of your working years. Because they start looking at that at 63, and there are times you can get out of it. You are not going to be able to get out of it if you are retired and say you're age 67, you're cruising along at 185, and then you you sell a rental property down at Smith Lake and you make $500,000 of capital gains. Yeah, you're not going to get out of it at that point, because one of those life-changing events at the top of SSA 44 isn't selling a property. You don't get to get out of it because of that. So again, just another IRMA level there that we can talk about. IRMA levels is something we have to be careful of for sure. And,
one thing that a mistake I'll see people make occasionally here is, they'll turn 65, not on TRICARE or anything, just working for a company. Let's say they're working for a big engineering firm in Huntsville, and they'll be like, well, I got to sign up for Medicare, so I'm just going to take A and B and, just go ahead and sign up. I'm going to retire pretty soon. And, if they're still working and they're taking Medicare and they didn't have to sign up if they have, credible health insurance, which they probably do if they're working for a very large, engineering firm, and then they're paying a lot more now because of these IRMA rates for their health insurance than they would have been if they had just waited until they retired. They lose their ability to do an HSA. So, it is one of those things that, for the retiree with a lot of pre-tax money saved, I think IRMA just becomes what I call sometimes a rich person problem to them, where it's like, you're just going to have to face the IRMA bells at some point. And, either with RMDs or Roth conversions, you're going to go through at least one or two of these brackets. But, for the average person in retirement, it is more about, how can we mitigate this? Because if you're not trying to Roth convert, millions, or not taking RMDs on millions, or you saved more Roth and after tax than you did pre-tax, then there are definitely a lot of ways to still get you a lot of income without having to worry about those increases in your premiums.
Did you say the IRMA bells?
Yeah.
What do the IRMA bells sound like?
I have no idea. I don't actually really know what I was going for with that analogy. I think I was thinking like hell's bells kind of.
Oh, yeah, hell's bells.
IRMA's bells, you hear them ringing.
Oh my gosh.
Well, some might consider it that, actually.
Yeah.
You may have
not too far off.
You may have come up with a new term, Graham.
The IRMA bells.
Yeah.
Write a Christmas song about that.
Yeah.
Right?
Yeah.
Give it to AC/DC. Let them.
They could probably do
Irma
that.
bells.
Yeah.
We should do that. That would be funny. All right, we'll go over one more actually that you can run into capital gains rates. So there's 0, 15, and 20%. And I think that, I mentioned the house earlier, selling the rental property, and you've got capital gains, or maybe it's your secondary property. You're going to have some capital gains there. For a married couple, the top end of the zero bracket is $48,350. So sometimes we feel like if someone is sitting on appreciated stock or mutual funds or something like that, you can sell those early in retirement when your income drops. And if your income is low enough, you're going to be able to kind of get away with some 0% capital gain. So you can really sell a long-term asset, so held longer than 1 year, and not pay any taxes on it. The other bracket up from that is when you cross over $48,350. I'm sorry, $96,701 is the married couple. I'm sitting here looking at the charts. When you cross over $96,701 as a married couple, you have all the way until $600,050 to pay 15% capital gain. So there's a big, wide margin after you cross over $96,701 to remain in that 15% capital gains area. But my point earlier was, for a married couple at $96,700, you have a pretty big piece of real estate to sell a long-term asset and pay 0% capital gains on. So I think there are some people that you can, build strategies. If you're selling a business, maybe looking at a structured payout versus, just a lump sum, or maybe liquidating a long-term asset over X number of years. So maybe you have some appreciated mutual funds, and you might want to sell them over 3 or 4 years because you want to start generating income and want to divest a little bit in those funds. You can be strategic about that. So that's another kind of a hidden tax, in my opinion, that more people know about. More people would know about capital gains. So if we put the 0.9 Medicare, the NIT tax, and the IRMA and the capital gains in a 1, 2, 3, 4 order, and ask just the random population to pick which ones they know about, they're probably going to say capital gains, and second would probably be IRMA. The other two, they'll be like, huh? What are those?
Yeah. And capital gains is, I would say it is one of the more confusing ones because of how the brackets are set up with that 0 and 15 and 20. And they're still different if you're married and single, and and the limits don't totally make quite as much sense as the marginal ones when you're jumping from single to married. They're not all just like basically half, like a lot of the marginal rates tend to be, or close to it. I heard somebody recently, I was talking to someone, very, very smart individual, and, someone that I would say probably has a decent bit of financial literacy on their own right. And they were talking to me about how they wanted to diversify out of a concentrated position. And they said something to the effect of, well, I know there's the 0% capital gains bracket, so I was just going to sell just enough to stay in the 0% capital gains bracket. And that all sounds great until you realize, well, that is tied to your other income too. So if you're making 6 figures plus of income, that 0 bracket doesn't exist for you anymore.
No.
So they were thinking, oh, well, I make a couple $100,000 a year, but I don't have any capital gains. So I'll sell enough to stay in the 0. It's like, no. That 0 is based off of all your income, not just your investment, capital gains income. So, it is one of those things that I think it's kind of tough to understand and fully grasp. And, you got to pay your estimated taxes a lot of times with that too, because you're not withholding from it. So it is a really tricky part of the tax code.
So you're exactly right. That person was mistaken just because they make over that number, so they're going to be out of it. You mentioned something else too about sometimes the brackets are a little bit funky. So with the Medicare tax, it's $125,000 of income for a single individual, and it is double that for a married couple. However, the NIT tax is somewhat of a penalty to a married couple because the NIT tax modified adjusted gross income is $200 for the single individual, and it's $250 for a married couple. The IRMA brackets are kind of half, and the cap gains, as you just mentioned, are what they are, and there's some ordering rules that kind of happen there.
It's funny. You wonder. I heard someone, a client recently talking about like tax rates on or I think it was payout rates on Social Security. Anyways, something about how the federal government is setting up these different rates. He's like, I feel like they just spin, a wheel and throw a dart at it and just see what number it lands on. And sometimes it does feel like that. So you really do have to know, what you're dealing with, especially when you're, selling assets and doing something that's going to trigger taxes that are not going to get withheld for you. If you're single, married, and just kind of know where all that lines up.
Wow, such good information here. And yeah, things that a lot of us don't know. But how about this one? What about Social Security? Let's talk about that.
Yeah, let's talk about it. It's not free like everybody seems to think it is. More and more people are starting to realize. But let's just go with the worst case scenario. Up to 85% of it could be retaxed. So what I always tell people is out of an IRA, it's subject to 100% taxation. Well, at least with your Social Security income, the most it can be added into your taxable income is 85% of that. So you're basically getting 15% for free. And this is why we are extremely adamant about looking at Social Security from a tax perspective and then also from a survivorship perspective versus a break even, which is typically how most people look at it. I think Graham said it best on one show where he said that people treat Social Security like a game. We think that we should treat it from a tax perspective first, and a survivorship is probably a close second and sometimes might even be first. So that's, Social Security is not free, but it can be if you make low enough and you're able to live off of your Social Security income together and you're not pulling any other income in. It actually can be taxed at a 0% rate. So I gave you two of the best and worst case scenarios. If you're able just to have just Social Security income, you're in a zero bracket, both federal and state in Alabama and Tennessee. And then on the top end, only up to 85% of it is taxed.
Okay. And then I guess for the last question, how do you help people put all of this together?
Yeah, I think, again, this is, like we said earlier in the show, this is really confusing to a lot of people. And there'll probably be some people that'll have to go back and re-listen to the episode. And if you heard me earlier, I was talking about the Medicare tax and the, income and modified it. It's very easy to get it kind of confused and twisted. So what we do, we use a process at the office. We use a, Rite Retirement process, and we have a report card. And it's kind of set up to help us ask the right questions and know when you're going to cross over certain thresholds for us to be able to say, hey, did you know you're going to be in this area when it comes to income? And here we can reduce your income by doing this. So Graham mentioned earlier about somebody paying extra tax, really because they're just sitting on a lot of excess money that's getting hit by the NIT tax. And it's just adding additional tax to their bottom line when at the end of the day, there are ways to reduce that. There are ways to reposition money so that you're not getting hit with some of those taxation things that are buried within that tax code. And I think that is what typically separates us from a lot of the other financial planning firms out there. We're not the only one that looks at that, but I would say that we're one of the few that kind of dives into things a little bit deeper to educate our prospects and clients so that, together we can make better decisions. So if you'd like somebody to take a look at your retirement plan, you can give us a call at 256-937-2010. Again, the number is 256-937-2010. I hope everybody's enjoyed this episode. I'm kind of glad to be done with it because it's a lot of tax and technical talk.
It's good stuff, though.
Yeah, I'll rest well this afternoon. But again, thanks everybody for listening. Hope everybody has an awesome and blessed week. And remember to serve every person in every situation with a servant heart.
Graham Bauer holds the enrolled agent designation, but is not currently offering tax preparation services. Neither the firm nor its agents may give tax advice. Individuals should consult with a qualified professional for guidance before making any purchasing decisions.
Investment advisory services made available through AE Wealth Management LLC, AEWM. AEWM and WG Financial Group are not affiliated companies. Insurance products are offered through the insurance business WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by WG Insurance Services are not subject to investment advisor requirements. AEWM and WG Financial Group are not affiliated companies. companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only and is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. WG Financial is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. Information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial. This radio show is a paid placement.